Good morning. I'm Peter Cowan, Managing Director of Sutton Capital Partners and co-founder of the Recurring Revenue Conference. Welcome to our fifth and final of our weekly series on the mindset of an investor today. We're very excited to have Minnie Ingersoll, partner at TenOneTen Ventures and co-founder of Shift Technologies. TenOneTen Ventures is one of the top early stage venture capital funds in Los Angeles, with partners who created what is today Google AdSense. Their investments include companies such as Scopely, Pluto TV, MapSense, Kaggle, and Social Native. Before becoming a VC, Minnie co-founded Shift Technologies, a used car buying platform that attracted multiple rounds of financing from investors such as DFJ, Highland Capital, BMW, and Goldman Sachs. Previously, she worked for 11 years at Google as a product manager and then as a principal. Things around us only get more turbulent. I hope everybody's doing well. Obviously, the issues with Black Lives Matters and everything around is deep in our conscience, and I hope we're going to find solutions that have showed some deep wounds in our country, and I think we're all going to be thoughtful about that. We plan to talk to Minnie for about 30 minutes and then have 10 minutes of Q&A. Please send any questions you have through the Q&A tab on the toolbar at the bottom of the page, and we'll answer as many as we can. Minnie, welcome. Thanks for being with us. How are you?
I'm good. Good to be here. Thank you, Peter.
Good. Anyway, so before we get started, one of the things we always like to ask is, tell us something a little bit about yourself that people don't know, besides the fact that you're, worked for a major company like Google for many years, co-founded a company and a venture capitalist. Tell us something you'd like to share.
I will do that. I will also echo what you said about Black Lives Matter, and that has, in terms of mindset of an investor today, that's been very top of my mind for the past couple of weeks. So I just want that to be part of the conversation as well. Things someone doesn't know. So I have two brothers, two sisters, and when I was growing up, I had 5 Caltech grad students living with me in our house. And now I'm back in that same house where I grew up, and it's a treat. I'm back here in Pasadena.
So things can come full circle and you can come home.
I don't have 5 grad students living with me currently.
But you're back in the same home you grew up in.
I am.
Oh, that's it. Well, good. So one of the things I want to start off about is, what's changed today? Obviously, there's been over 3 months now where we've been essentially in quarantine. There's been a lot going on in the environment. We're starting to see things open up a little bit. We're seeing some big deals going on that are getting done in the venture community. Some acquisitions are getting done, but we're also hearing a lot of issues, and some of the venture capitalists in the past have said things are changing. What do you see the landscape today? What's changed over the last 3 months?
Yeah, over the last 3 months and the last 2.5 weeks, for sure. We're all working from home and doing meetings over Zoom. I did look up some numbers ahead of time because I thought having numbers is always more helpful than just having opinions. So I'm a member of the Foundry Next. TenOneTen has Foundry Next as one of our LPs, and they do a good job of bringing their GPs together to do things like ask questions like, how have you seen valuations change? And NFX also did a great survey with 600, I believe, founders and VCs. The consensus there was that valuations are coming down 20 to 30%, and also that the outlook for how valuations might continue to change would be that valuations might continue to come down to 40% below what we saw pre-COVID era.
Now, do you think that applies to just startups, or that apply across the board? Because we're certainly seeing later stage deals that are rich, but these are obviously more established companies. What's your take?
Yeah, I think that the numbers that I was talking about were more in the seed to Series A sort of range, which is where I invest. So it is where I have been spending more of my time looking. I think that what I have heard repeatedly is that the difference between sort of the haves and have-nots in the startup world has gotten greater. So the people are raising the bar for what they're willing to fund in later stage growth rounds. They're looking for more traction. They're looking for better metrics, which means that if fewer deals are getting done, the ones that are hot have become more highly contested. And so those, I think, are keeping the valuations high for the deals that are getting done. But I think that the bar for being able to get later stage rounds done has gotten higher.
Okay. So one of the things that we saw early was that people retrenched a bit. Venture funds had to look at their existing portfolio, make some decisions, put resources into them, decide that some of them might not make it. Some are doing great, others need some sort of arbitrage and longer runways effectively, which might forego current growth. Are you and your fund actively looking for new deals more than ever, less than ever? Where are you in your own cycle on opportunities, and where do you think funds like yours are?
Yeah, you know, the way venture works, I know you know this, but we raise our fund and then expect to deploy that capital over some 2 to 4 years, let's call it, of making those new investments. And so, you know, we have a fund where we need to make great investments, and we continue to do that. I think that there definitely was a huge amount of uncertainty at the beginning of this, where everyone relooked at forecasts and relooked at runway. But out of that, because I think those exercises have happened, everyone has, you know, red, yellow, green, those sorts of metrics around their portfolio. But I think out of that, we've actually made some investments, perhaps as a reflection of that exercise, which is a lot of founders, conventional wisdom now is you should have 2 to 3 years of cash runway. So that's higher than it was. So we did an investment recently, post-COVID, that was a company that would have been raising a Series A, but we were, you know, they wanted to extend their runway, so there was less pressure to raise an immediate Series A. So we were able to invest in a pre-Series A sort of round. I also think all the disruption is creating interesting opportunities. So there's some companies that are getting a lot of tailwinds because of the current environment. So yeah, we've made 4 investments in the past 3 months, I think, approximately. So since lockdown, so we've been extremely busy.
So let's go into those, because I think that's great. And you know, when you and I talked about this, 4 investments in the last 3 months, given that you're an early stage company, that's a fair amount. And you know, at that rate, you'd be making more than 12 a year. So that's a pretty aggressive amount. Can you tell us a story or two about them? Obviously, some of them you must have known in advance. Did you know all of them in advance? Had you met them all in person before? Give us a little story of each of them so that people can get insights. Your thought that you came into a Series A and you got it with a smaller amount at a seed round meant the valuation was a little lower than their expectations were earlier. Maybe touch on that one, and then give us the experience of what it's like as you went through and how you got and how the funding process worked.
Yeah, I was just trying to remember. I said that and I was like, I need to remember which they are. I've just been, you know, context switching. So yeah, the one that you're talking about, you know, they did end up taking capital at a lower valuation than they would have pre-COVID raising a Series A, but they also took less of it. So, you know, it wasn't a full Series A. And that company we had known beforehand. So that was one that we hadn't actually we didn't invest in the seed, and I think regretted it or didn't do a full evaluation at the seed stage, but then have been following it. So they're a local LA founder. So, so that was just an opportunity we took advantage of. On the other hand, we did an investment in a company called Cerebre that we only met via Zoom. And I will say a few things about meeting companies on Zoom. One is I was talking with my partner, David Waxman, who you know, and we were talking about Cerebre. And someone said, well, did you meet them in person? And David and I looked at each other, and David really had to think about it. Now, I knew we hadn't met them, but it was one of those, we've had enough Zoom calls. I feel very much like I know the founders. We've just spent a number of months talking to them repeatedly on Zoom. I feel like I have a very good sense of them, and yet we didn't meet them in person. And I also, you know, I think everybody is welcome to have their own opinion on this, but I have made wonderful hiring decisions on Zoom. So when I was at Shift, one of my best hires was a person who lived in Germany when we were interviewing him. He had a young family, so he wasn't able to fly to the Bay Area to interview with Shift. We did a number of Zoom calls with him. He then relocated his whole family once he had the offer, and he was one of our great hires. So I feel comfortable meeting people on Zoom. I think some things about that are different. One thing might be that you're able to do more Zoom meetings if you're not driving across town or flying, across the country or anything like that. So, I think it's possible that we're meeting more of the team than we might have been otherwise, beyond just meeting the two co-founders or something like that. Personally, I feel like meeting people with masks on and shouting 10 feet apart isn't the same experience as actually talking to someone on Zoom. One of our fellow GP sort of co-investor funds was saying that he likes to ask more oddball questions, which I kind of like. Over dinner, you get into more random discussions, but over Zoom, you sometimes get into that, like just stepping through the slides in a PowerPoint. So perhaps he asked questions like you about, something people don't know about you, your siblings, that sort of thing.
Well, Minnie, I thought you brought up two really powerful points. The first is you as an operator have had to deal with Zoom in hiring before as you scale the company. So you had a certain comfort level with it. The second thing, though, is venture capitalists who in the past haven't used that as a way, and they insisted on having a personal meeting, and that was an expectation. I think you brought up one point I'd like to go into, which is that the randomness and the expectation that things go off script is easier to do at a dinner or anything like this. And what you're talking about is people get a comfort level by being able to get a personal interface where you're not on. And that's the whole idea of having drinks or dinner and all this. And what I heard you saying is, in these interviews, you have people that ask questions that are a little off the wall, which is trying to be a substitute for that. And that sounds like an important thing to do. And I'm trying to look at our listeners who a lot of them are going to be making their pitch. Any suggestions on how to get through that more personal level when it's only on Zoom?
Well, one thing I'll say is this situation is going to be here to stay, and I have other thoughts on why we're going to be working from home for a long time. Not unique to me, but again, statistics and polls there. And so, if that's the case, that we're going to be working from home and doing Zoom calls, well, then it's a skill we're all going to have to master on both sides. Because one of the things I'm looking for is a lot of the companies I'm investing into at the seed round are going to go on to raise a Series A. And so if they're good at pitching over Zoom, that's going to be a skill everyone needs to master, right? On both sides, the VC and the entrepreneur. I think it is a two-way street. I think there's a lot of the same stuff that goes on, which is getting back channel references in both directions, both on the person who's giving you money and on the potential entrepreneur that you're funding.
Yes. I think, well, you mentioned a couple of points, which I think are what the new normal is, which you're talking about, more Zoom calls. And we're hearing from not only the people we've interviewed, but a bunch of other venture capitalists that in some ways they like Zoom because they want efficiency, or all of you want efficiency, and therefore you can do more Zoom calls. On the other hand, you're still not taking calls where somebody says, here's an email, I don't know anybody, please take this call. Or are you? Isn't it still through the same channels, just that maybe you've got a little more time to talk to more people?
I think maybe unfortunately, the warm intro becomes even more important. So if you haven't met someone in person ever, then knowing if you're a Series A investor, knowing the seed investor who actually did spend a year working side by side with this person does become even more important. And in terms of the efficiencies, it's efficient, but I think everyone's situation is different. I'm at home with 3 little kids, and the trade-off for me is I can hear my kids outside when I'm talking to you right now, as I can in most of my meetings. And that sort of, am I going to take one extra meeting, or am I going to, you know, spend a little bit more time with my kids? That trade-off, when there's just one door, one window, I can see them outside. It's hard. I'm definitely spending more time with my family than I was before. I'm also not traveling, so that helps. But you know, I definitely think it's still a good time to raise, because you can, the bar is pretty low. I mean, the barrier there to take a 30-minute Zoom is pretty low.
So, all right, well, that's helpful. So let's walk through a little bit of what's going on. You've made 4 investments in 3 months. Obviously, you're making a series of investments before, and you've had some very good companies, and you have done, you're not surprising, you're involved with a bunch of companies that are involved with big data, SaaS, deep customer engagement, heavy metrics. And so one of the things that was done before was a lot of SaaS companies were real focus on growth, even if there's meaningfully larger losses. We're certainly seeing that change, and obviously there's more runway. Can you give us some specifics that you're looking at as far as evaluating what the runway is, the cash needs, and how quickly companies need to get to certain levels, for example, in the SaaS world? Any thoughts?
Yeah, so I was saying that we were part of Foundry Next, which is Brad Feld's group. And yeah. I think it was Brad who said, later stage investors, they're going to look at how did you grow in 2019? How did you grow in 2021? And did you survive 2020? And I like that. I felt like it sort of nicely summarized things. And so, you know, people worried about growth right now, this is not the time. There is so much uncertainty in the world. I think we are in survival mode here. You know, I think things like 2 to 3 years of runway, to me, sounded very high before going into this. But now I think, especially like those numbers I was telling you where the VCs polled said that they saw valuations coming down 20 to 30%, but they expect them to come down more, 40% or more. So I think it's still a good time to raise. And all of those valuations anyways, to me, sort of are funny money. And so it's more relative to what the next round looks like and how much capital you have.
Sure. Well, so is there any advice you would give to entrepreneurs to prepare for a Zoom meeting? Obviously, they should look at the portfolio of the companies. They should look at the biographies of all of the people involved. You've talked about setting expectations so that they're not burning through a lot of money fast, because this round has to go further. Is there, you know, and you've also talked about having perhaps more people available so that you can go deeper, faster with a broader team.
Yeah.
How about the presentation, the formality? What goes on in a conversation? Are these 30-minute slots, hour slots, and is there small talk? Is there what is it? These are slightly different ground rules. You're doing this every day now. They're coming in for the first time. Any pearls of wisdom?
You know, I think I don't have a whole lot of new pearls of wisdom other than my regular pearls of wisdom.
Please share those pearls then.
Well, okay. So first off, I was doing most of my first meetings on Zoom anyways. So for me, doing a first meeting on Zoom was what I was doing beforehand. And usually for me, it is a 30-minute meeting. And I think 2 things that I advise, I guess, entrepreneurs, which are maybe kind of contradictory now that I think about them. One, I say, think for yourself. And the other, I say, ask for feedback, which sounds extremely contradictory or fairly contradictory. But I think that the people who get the best feedback, because, you know, we all know that you're not going to get money from the first person you talk to. So you're going to have dozens of conversations in the process of fundraising. And so the people who don't end up funding you can be a great source of feedback if you are really open to it, right? And it's hard to give feedback. You know, if early stage VCs say that 70% is about the team, well, it's hard then to give the feedback, which is the team wasn't good for some reason. Like, you know, it's much easier to give kind of wishy-washy feedback about, oh, I don't believe in the market, or the product is, you're too early for us, or something, right? And
Yeah.
so people who do a good job of being open to feedback, and
Yeah.
that's true whether you're on Zoom or anything else. But at the same time, asking for feedback, but then realizing that the VC is not your customer. And so, you know, that is a mantra that everyone needs to remember, which is the VC can give you feedback on how to raise money from a VC, but not on how to build your business. And ultimately, if you build a good business, that's how you will end up getting money. And so not to over-index on the venture capitalists, or, you know, I see people now who are coming out of entrepreneurship programs and everyone has a Tam, Tom, Sam slide. And I just want them to look at me and explain why it's a huge market opportunity, and to be genuine and not try to sort of reverse engineer the VC slide deck, if you will.
Good. That's helpful. There does always seem to be a TAM and what the TAM is as you go deeper and have that described. I agree.
Yeah.
Now, I want to take one moment, because one of the reasons we're excited to have you, Minnie, is you are a successful entrepreneur. You had to, and frankly, as a woman, had to go and pitch venture capital, and you went to some of the top firms. So you went to many of them, and you were successful in launching a business, raising capital. And I want to take a couple of minutes just to have you put on your other hat, which was, you know, entrepreneur, founder, venture backed. Share with us your own feelings and emotions. And of course, you bring it full circle, because we'll talk a little later about your own podcast. So here you are, both as an entrepreneur and now a venture capitalist, and as an interviewer and interviewee. Tell us about, you know, when you went to present, what went on. Obviously, it's intimidating to get started to any of the top venture capitalists, but as a woman, we all know that there's a lot fewer women than men that get funded. Share with us that experience.
Oh, there's so much there. I want to say so many things. So first off, I think there's just this question of how decisions are made in the world, like how things are allocated and how to make sure that we are building cultures that make sure that the important things that are being allocated, and capital is one of the most important things, are done in a way where different voices are able to thrive. And so, you know, Google product strategy was where decisions got made at Google, and that was usually around allocating engineering resources. But it's fairly similar in how capital is allocated for raising money. So generally, you meet with someone at one of the Sand Hill Road funds. They become your champion. They then decide to take you essentially to the Monday partner meeting. The Monday partner meeting, you have most of the partners all assembled, usually around a table. For us, this is pre-COVID. You have some people on video potentially, but you've still got, you know, a room full of, you know, mostly white men. I think things are changing some, and then they grill you on your, you know, projections and your assumptions, and I found that a quite intimidating process. But also, I think, you know, now moving over to the venture side of the world, Austin Clements, who was my colleague at TenOneTen, Austin and I would sit on a panel together. We sat on a panel together, both talking about the same thing. We write the same size checks. We're part of the same fund. He's a Black man from LA. I'm a white woman. And after the panel, all the people of color line up to talk to Austin. All the women line up to talk to me. And I think that's, I think there's many reasons for that, but I think that people do feel comfortable talking to people who they feel kinship with. And so, you know, when I moved to LA, I didn't have a job, and I felt much more comfortable reaching out to the women in LA because it is a group that I feel comfortable with. And to tie it all back to my podcast, thank you for bringing it up. I find that when I listen to someone talk for an hour or 45 minutes or however long, you know, a podcast is, or a webinar like this, I get a much better sense of whether there's someone I want to work with, or, you know, they become much more humanized to me and not sort of an intimidating Mark Andreessen who has all the answers. Much more of a sort of fully shaped person. And so some of my goal with the podcast in my small way was to help just people get to know the potential check writers before they raise money from them.
Sure. The so I think that's a very helpful perspective, and I'm glad you could share your own experience on it. For the last few minutes of this discussion, I'd like to talk about going forward. What do you see? And so, are there sectors that excite you and sectors that don't? Are there opportunities and growths and trends that you see, that your fund looks at and says, this is an exciting area, or you personally, are there things that have changed and you think are not attractive? And are there any things that you're, maybe more excited about that other people aren't?
Sure. Again, many threads to pull here. So you talked some about what TenOneTen tends to invest in. Like one of our sweet spot investments is automation and efficiencies for big legacy industries. I think Mark Suster has been talking a lot recently about what happens in a downturn. And the truth is that managers throughout the large companies have their budgets cut. And where it used to be that everyone was talking about how to build innovation into these large companies, now everyone's talking about cost savings. And so things like automation and cost savings, a lot of technology can apply there. So we have a number of investments in that space. One of the companies I was talking about that we funded recently is automation for customer service, where you can actually resolve tickets for customers who have questions. Those sorts of tools continue to be interesting. Another big trend, obviously we're all working from home and that's here to stay. In this survey that I thought was particularly interesting, I think NFX was the broader survey. It had 600 respondents of CEOs and VCs. The question that stood out to me the most was, do you plan, this is of the CEOs, do you plan to have a fully remote or majority remote workforce indefinitely going forward? And 75% of people answered yes to that. So this wasn't like in the immediate term, but it was a majority of the workforce being remote. And so that's going to open up a whole new world of the way we work and the way we live. And another thing that I'm really excited about with this trend of working from home or working remotely in different capacities is, I think it's going to just have a great effect on ecosystems outside of Silicon Valley. And I think, we're all doing things over Zoom. And so people are not advantaged as much if they're running into people in the South Park, the Blue Bottle Cafe, or wherever people hang out nowadays and rub elbows. We're going to be able to do a Zoom with someone in Lincoln, Nebraska as easily as we are with someone in Menlo Park. So I think that's really exciting and great for LA.
So do I, and it's a perfect segue because we're getting a burst of questions on exactly the area that you're interested in and just talked about. Are there, with the new work at home economy, the idea that people can live anywhere, you're no doubt seeing a number of types of companies that are offering certain solutions to make this remote workforce effective, especially given your own background at Google and your comfort with Zoom and teleconferencing well before this. Can you share with us some ideas within that at-home new opportunity? Because we're getting several questions from listeners that's an area they want to learn more about, and I think you're a fund, and your own personal experience would give a lot of insight.
So on the one hand, I will give my total cop-out answer, which is, as a fund, we like to say, what are big trends that are happening? And then we don't believe that some funds are great at coming up with their own thesis, having a whiteboard behind them and deciding what that means. We really prefer to have entrepreneurs who see things deeply and come to us. So I will qualify it that way. On the podcast, on my podcast, I had Brendan Wallace from Fifth Wall on last week. And we were asking about how the real estate is going to evolve and react to this. And he's really a believer that the 9 to 5, 5 days a week work week is going to change. Now, we also discussed that those of us with children at home, in order to change that 9 to 5, 5 days a week, daycare or schools will also have to change. But I think it's a very valid point, which is rethinking that interaction also as it relates to space. And so really the reason you're going into the office is for an experience of some sort. And maybe you do, your strategy sessions 1 day a week in the office. Maybe you have marketing only there, 1 day a week, and rethinking what that means in terms of, how teams cross collaborate, I think is going to be really interesting. I think a lot of anecdotes, I think we call them anecdata here. A lot of anecdotes I've heard of teams that have been a lot more productive. We've looked at things like sprint metrics and what's actually getting built. A lot more productive, but you lose that cultural aspect. How do you onboard a new employee in this current environment? So thinking about that, but I don't yet know where that will lead our investments.
Well, Minnie, you're sparking a lot of great questions. Don't tell the other previous speakers, but I think the questions here are among the most interesting that you're provoking. So
I haven't been reading the questions because I've been so busy talking.
No, that's my job. You don't need to. That's my job. So let me tell you, because we're going to pick out a bunch. There's a flurry of them. But I think what we're hearing is you love the sector. You want to see the entrepreneurs come in. You want to see a warm introduction, so somebody credible that talks to you about it. But also what we're hearing is some people are saying, well, then if you're open to more remote workforces, would you also be open to people who are founders in other parts of the country? In other words, often seed funds and early funds have had a preference. If they're in Silicon Valley, they're in Silicon Valley. They make an exception sometimes if there's something in another part of the country, but that's more the exception. With this virtual work at home, the experience being through Zoom, are you open to investing in places outside of your local region?
Absolutely. Absolutely, 1,000%. It's one of the things that I'm very excited about. I think some of it is that we can all do Zoom meetings, but I also think that it's a trend that has been going on for a while, which is entrepreneurship and startups and how to get funding used to be more of a black box a decade ago. You used to sort of have to be part of, be in Sand Hill Road and know the people and all of that. But now universities are teaching entrepreneurship. I went to school and no one talked about how to be an entrepreneur. And so I think a lot of that is being demystified, not just in school, but there's so many more resources. And so I think that's also enabling this wonderful rise of innovation in all parts of the country.
Very good, very good. So you're saying that your fund and you're seeing others, you think there'll be more investments in the portfolio that are outside of a local area, that including foundries, funds, and all this, and you think that's a trend that's going to continue here, and you'd encourage people to reach out to you regardless of where they're located?
Yeah, we are, as a fund right now, we're about 50% of our portfolio is in LA. I think that where we will really grow are, I think the decline will come in investments in Silicon Valley. I don't know, I like to follow the entrepreneurs, but also I think the exciting thing is the big industries that can have disruption. I like entrepreneurs who are deep in the business that they are building a company on. And, if you're working on agriculture, if you're working on manufacturing, logistics, a lot of the manufacturing is not in Silicon Valley, right? And so those industries that haven't been as touched by technology, I've been working on used car sales for the past 6 years. Those industries are not in the Bay Area. So I think that's a great opportunity.
Sure, and as well. And so as you're looking, one of the things that's come on is, whether it's Silicon Valley in particular, but Los Angeles as well, is talented people often are in the same city and often have higher salaries. We're seeing some companies that are doing more remote, which also has the advantage that people can live in lower cost areas, have more flexibility. And also, are you seeing that continue? And are you also thinking that that may have an impact on costs for talent as people can be recruited from around the country?
Yeah, I mean, I sigh just because the thing that I worry about, and the trend, if you want to know, like, what's a trend right now, is higher unemployment.
Yep.
The stratification of our society. These are other things that that I know you didn't just ask about, but there are things that, you know, can we be doing more to invest in solutions that are addressing the bottom half of society rather than the top half of society? And you know, and even what are the second order effects, to speak like a VC? What are the, not, you know, what are the second order effects of having higher unemployment? What does that mean? We made an investment into an online pharmacy that's Honeybee Health, that's allows you to buy drugs without going through insurance, so you get lower prices because it skips the whole insurance infrastructure. And you know, more people being unemployed means that there will be more people without insurance. But yes, lower cost of living allows, it is a good thing, I think, that is happening right now, which is the talent market. I think people can hire more easily to build their startups.
Sure, sure. And so as you look at companies, and let's just go, maybe dig a little deeper into this, we're getting a few questions on, when you're looking at forecasts, have you shifted from something that's a faster growth to something that's a little slower growth with with a little slower burn rate? Is there some ratio or anything that you share, or is it more just qualitative that we need to last the money longer so things are slower? Is there any metrics you want to share, or just a general feeling?
You know, I don't have a great metric to share there. What I would say is, you know, most of our investments are B2B. And so we are doing a really good job, heavy look at who are all your big customers today, who are the big ones in the pipeline, because a majority, I would say, of our portfolio really has not been directly affected right now, because they're on annual contracts, those sorts of things. But it's understanding what the dynamics are within their customers. And so that's where I would pay close attention to and be very comfortable understanding that, and realizing that some of those contracts will renew at lower rates.
So one of the things you bring up, which I think is a great point, is who are your portfolio's companies? And bigger ones, in specific industries, are more likely to be stable and important. And you have some fears of some smaller companies and the volatility of who those clients might be. Either they won't come back or they'll be more price sensitive. And that's part of your analysis when you look at opportunities. Is that fair to say?
Absolutely. I think, you know, when we look at things, I think it's reasonably easy to see what industries have headwinds and what have tailwinds. You know, we have a company, Ordermark, that is in the food delivery space.
Absolutely.
Great. We have a company called Well Health that has hospitals as clients. Not they're doing very well. They're well capitalized, thankfully, but you know, hospitals have been hit hard. But you know, you also look at what's hit hard structurally and is going to come back, what isn't going to come back, right? So I think it's reasonably easy to see the headwinds and tailwinds there, but I think it's harder to know where the valuations would go.
Yeah. No, and
so we're looking good.
And see, so, and we're getting a number of, there's obviously a lot that's going on with artificial intelligence, machine learning. We see it across a lot of areas. You mentioned a healthcare company. Are you particularly bullish or not about the changing healthcare world? How AI fits in, how mode of delivery is that an area you look at or not?
Yes, absolutely. I think it's very interesting. I think it was Jay Goss, one of your questions up there. Did I see him go by? I think this move to value-based care is extremely interesting. I don't have great data on who's being hit harder in this in this downturn in the healthcare system, but people who are people who've been fast to get up to speed on the value-based care delivery. So you're not making money. Your incentive is not to keep your hospital full, right? That is the wrong incentive for, a hospital to be incented on getting more money because everybody is sick and staying in your hospital, right?
Yeah.
And so I think there is a huge opportunity in our healthcare system. With Honeybee Health, the company that I mentioned, they were actually able to take advantage of some loosening regulation and to be able to sell in states, sell cross-state because the regulation had changed. So they're now open for business selling these generic drugs in Oregon because of some regulatory change. I think massive change with insurance reimbursement and telehealth. So I think there are some interesting changes that some of it is being driven by the regulatory side of thing. I know you started your question with AI. We have a company called Health Tensor that does artificial intelligence diagnoses for physicians. But really what they're doing is they're not taking the power out of the hands of the physicians. What they're really doing is doing better coding. And so coding of conditions based on reading the labs and reading the EHR records. And so what they're really able to do is sort of do the busy work, if you will, of doing better coding, which enables hospitals to get better reimbursements, enables physicians to spend more time with their patients rather than worrying about the coding. Anyways, I am very excited about the health tech sector.
Very good, very good. Our last question is going to be from another venture capitalist. Most of the people who listen in are founders, CEOs, people going to launch business, or multiple CEOs. But our last one's going to be from a venture capitalist, which is, besides the Zoom meetings, in the area of due diligence, do you do more due diligence because you're not meeting these people face to face with other sorts of ways to give you that comfort that they are who they are? Are you doing more or not? Or different?
Yeah, I think what I said, which is, one, we are talking to more people on the team. We are talking to people who sort of those references of, whether it's references from people, prior employers or something like that. I personally, as I said, a Zoom meeting versus an in-person where we have masks on, I actually find in-person with masks on really hard. And so I also think I don't want to create pressure for an entrepreneur to meet me outside with masks on if they're still not feeling comfortable going out into the world and meeting in person. And so I'm all Zoom all the time. I do some on phone occasionally so I can go outside and take a walk, but mostly I just hang out here. I'm in my little shed in my backyard. It used to be our laundry room. Anyways.
Very, very good. Actually, the final question we'll have, and thank you for staying a little longer. The final question we have is, are you seeing a cross-section or change of a different sort of people, whether it's by age or others, in this time? One of the things that we think about is that older people are going to have to be more quarantined for the foreseeable future, probably more than younger people because of the severity of COVID. We're obviously also seeing just very recently the Black Lives Matters. Maybe that's too soon to have an impact. Do you see any changes now or changes in the future, do you think, on the type of people that are coming by age, nationality, demographics, other sorts of things, even perhaps with other unemployment? Are things changing or not?
I certainly hope so, Peter. I really hope that the Black Lives Matter, I think we need police reform, but I think we need structural reform, right? And I think that the way you get there is by time and money, are two of the big levers that we have. And I think that we need to decide what's important to us and then spend our time and our money on what's important to us. And so I think that this will lead to a lot of demographic changes. I think some of it does depend on what we were talking about before, which is what sectors are we talking about? Like, I think government reform and government digital services is something I have spent my personal time on. So how do you actually receive services from your government is now extremely digital. But if you're investing into government, if you're investing into agriculture, if you're investing into logistics, your founders are going to look very different and hopefully reflect the industries that you're investing into.
Very good. Minnie, thank you very much. Really appreciated your insights, your thought, your views, and you bring a rich perspective to this. To all the viewers, there'll be a recording and we'll be sending you a link to that shortly. This concludes our series, but for those of you who wanted to see other webinars, please go to www.recurringrevenue.conference.com/virtual-events.com. I encourage you to see the past interviews with such well-regarded venture capitalists as Tim Draper, Mark Mullen, and Ben Narrison. Also, Arlen Hamilton gave a provocative interview just days before George Floyd was killed, and her perspective in light of that's particularly worthwhile. Like many of you, we at Sutton Capital are disturbed by the recent events, and we hope to do more to give opportunity to those less advantaged. If there are great entrepreneurs who have overcome difficult, tough circumstances, please let us know. And we plan to launch another series which will feature executives facing tough decisions they've made going forward that we'll announce going forward on that. Meanwhile, Minnie Ingersoll also puts on her own podcast, LA Ventures Podcast, which I'd encourage you to come listen to. As you can see her as the interviewer and interviewing a lot of the leading investors and entrepreneurs in our community. We welcome all feedback, good and bad. We want to continue to improve. We love the feedback we've gotten, and we continue to do that better. And we look forward to staying at the pulse of what's going on in the technology marketplace here. And we hope all of you are safe and well. Thank you very much. Bye-bye.
Thank you, Peter.